Hi there. Hope you've had a good day or are having a good day and not being affected adversely and annoyingly by some of the problems I'll be talking about in this video. There are certain things that business owners and non-financial managers working in companies can do to improve profitability and cash flow. These are not difficult things. They don't require knowledge of high finance or anything like that. So, what do? Well, we look at the things that I'm going to be talking about, and then all we have to do is to use plain common sense and then take action. The actions I'll describe to you in some detail. Now, a business owner is responsible for the entire business. A non-financial manager might be responsible for a certain part of the business operation, or maybe for more than one part of the business operation. But they all need to approach these problems in the same way. Now, what am I talking about? Working capital management. What is working capital for a start? Well, working capital is the relationship between current assets and current liabilities. Now, what are current assets? Cash, money in the bank or on the premises. We need to be careful about money on the premises in this day and age. Money owed to us by our customers. In other words, what we might call accounts receivable. Some people also use the term our debtors. Now, we need to look at what we can do to minimize problems in those areas. And inventory or stock. What are the problem areas? Why do we need to control inventory to improve profits and cash flow? And how do we do that? So, these are not technically difficult things to do. Current liabilities, on the other hand, are any money that we have to pay within this financial year, the current financial year. So this would be things like the suppliers. We'd refer to them as our trade creditors, people who've sold goods to us on credit, or services that they've carried out for us on credit, and we owe them the money. Other short-term liabilities could be short-term loans that we've taken out that need to be paid within this financial year. So those are current liabilities. And also things like the dreaded tax that we owe. Now, what is the relationship between these two things? That's what we need to look at. So, very often what people will do is to do a calculation. They'll firstly want to know what the net current asset figure is. And sometimes that is referred to as working capital. Okay, I'm not going to argue the point about that. This is about managing everything, not just looking at one number. So, sometimes what people do is to calculate what is called the current ratio. Now, it's always good to do calculations of a number of different relationships for a business, and percentages, such as return on assets, percentage profits on sales, and things like that. But the current ratio is very important because it can tell us a number of things. And also maybe it doesn't tell us anything. So how do we calculate this ratio? Well, let's say that we have current assets of 200 and current liabilities of 100. So we would have a current ratio of 2 to 1. Is that a good current ratio? I don't know. You see, there is no such thing as a good current ratio. There's only an appropriate current ratio, and that would depend on the nature of the business, also something to do with the size of the business, and the strength of that business's brand. These are all the things that will tell you something about what would be an acceptable current ratio. Now, I once came across a slim textbook which was being used at a business school to people who attended a management development program there, not the MBA program. And in this book, there were the various ratios and percentages and so on, all very interesting. But the current ratio, he had a balance sheet example, which he compiled, and then he calculated the current ratio. So it was current assets divided by current liabilities. And the ratio that he came up with was 3:1. And then his comment was, Company X is in a very good position. We don't know that just by getting a ratio like it. There's many other things at play. And anyway, as I said earlier, there's no such thing as a good current ratio or a bad current ratio. There are only appropriate current ratios. Right. What do I mean by that? Well, one of the things that could enable a company to apply with the current, to survive and to operate with a 1-to-1 current ratio is the strength of that company's brand. There are some companies that are able to operate with a negative current ratio. Coca-Cola is a very powerful brand. When they sell goods on credit to any retailer, large or small, they dictate the terms of payment. And those companies pay them. They know they have to pay them because they have to have that brand on sale, and if they didn't have it on sale, it would detrimentally affect their sales because, such and such a retailer is no longer selling Coca-Cola. What the fuck? This is no good. If I'm having my brandy and I expect my Coke, and then the wife has had to buy Pepsi Cola, this is going to lead to an unpleasant domestic situation. So retailers know this. So no such thing as a good current ratio or a bad current ratio. There's only ever an appropriate current ratio. So let's look at the main problems that are within the current working capital area. So firstly, those that are, I've been spending too much time staring at a computer screen today. Firstly, the main problem areas in the working capital area: carrying too much stock. Because that stock that is in your warehouse and in your factory waiting to be worked on is money that you have tied up. And you may well be in an area that this is costing you various things. So let's have a look at a list of that. First of all, if you're in a borrowed situation, you're paying interest on that money that you've got tied up in inventory, stock. If stock is around for longer because there is so much of it, there's more likelihood that some damage will occur to that inventory. If you have too much stock around, there's a possibility that theft will take place. Because if there are many things around, it's harder for people just to see by looking around that things are okay. Stock disappears sometimes. And then another big area is that the stock that you have could become obsolete. Take an industry that is producing technology products. There are such rapid changes in technology that the products that you're making might become obsolete at a very fast rate. It's not only technology products, it could be fashion products. Fashions change regularly. And so if what you're producing, with garments and so on, go out of fashion, well, you have a problem because you're not going to be able to sell them. So that's another area. Now those costs, whether they're ones you can calculate or whether they are risks, need to be considered very carefully. And of course the best thing you can do then is to carry as little stock as possible to reduce the impact of those things. Those things are often referred to as hidden costs, because they're seldom calculated per item that you're producing and selling. That sort of cost allocation doesn't occur. They're referred to as hidden costs. They may be hidden costs, but they are very real. So, the other area that we need to look at closely and consider what actions we need to take is our accounts receivable, or our debtors figure. This is the money that's owed to us by customers that we've granted terms of credit to. Now, when they open the account, they usually agree to terms, they sign papers and things like that. But we have to remember that the money that the customers are due to pay us and haven't is your money in their bank account. And again, if you're in a borrowed situation, you're paying interest on the money that you haven't received from your customers and that they should have paid you. So we need to do something about that. We're going to talk about that too. So interest and the risk, of course, of them not paying. If they go bankrupt, we get nothing. When the company's eventually the liquidation process has taken place, we get a few cents in the dollar or rand. Normally it's infinitesimally small. Another area that we'll look at is paying creditors, our suppliers, too early. Why would we do that? If we have an account where they've granted us a 30-day period or a 1-month period to pay them, we should stick to that. If it's a 2-month period, we definitely stick to that too, because that's what they've agreed to. So, again, the problem is, by paying them earlier, using your borrowed money, it's costing you interest. And if you're also paying them early, this may well affect your cash flow. So it's something that you shouldn't do. We'll be looking at that and how that happens or why it happens. So none of these things require a gigantic task force to look into them. We just need to understand the practical tasks that need to be done and implement and continuously monitor what we ask people to do. This is what we'll be dealing with next. Oh, by the way, on the accounts receivable figure, people regularly calculate, or they should be calculating, what is called your receivables days outstanding or your debtors days outstanding. And let's say that the number that we've had has gone up and down over the last months, and we start seeing that in the last month or two and this latest month, our debtors days has reduced by a reasonable percentage, and we're quite happy. The things are going well. People are paying us. The debtors days figure is an average of how everybody's paying. But some bad things could be hidden in that average. And to see what the potential bad things are, you need to look at a debtors or a receivables Age Analysis. This is a list of all the customers that owe you money, their names, total amount they owe, and then the columns across will be as follows. What they bought in the current month, so that's the latest month's sales to them, what they bought the month before, and what they bought the month before that. Now that might be well and good if those are the terms that they're allowed to, but if there's been some creep, in other words, they've been slowing down on their payments, there could be a potential threat of them not paying. Other things we need to look for is that if we see a customer who has been a good customer, and in the latest month, their purchases were zero. The month before that, they'd purchased. The month before that, they'd purchased. But what the hell's going on? Now, have they gone out of business and we just haven't heard about it? That's why they purchased nothing? Or have they decided to no longer buy things from us because they're not happy with either our product or our service? This is something we need to get our salespeople to investigate and report back, so that we can take the necessary action. Either to see the customer, find out what improvements we can make to our product or service, or if they're in financial difficulties, well, then we need to be able to start acting immediately to see what money we can recover from these people. That's normally not an easy task, but we need to act on that. So, don't be complacent just because you're happy with your debtors' days and you think, oh, that's good for our industry and so on. So let's look at what we deal with as far as these things are concerned. First of all, inventory. You could have a lot of money tied up in inventory, and what we need to ensure that inventory is going out as fast as it's coming in. It's not going to happen if we purchase too much, because then stocks are going to build up. So that's something we need to look at. We need to carry as little industry as possible to reduce the holding costs and the associated risks which I've outlined, theft, obsolescence, and so on, and the interest. So what do? If we can get this movement of inventory through our business, decreasing that cycle, sometimes called the cash cycle, from the time you pay for it until the time you get paid. Well, you would want to have some balance there. Ideally, you'd like to get paid before you have to by your customers before you have to pay your suppliers. It's possible in some industries when you're selling to businesses that sell only for cash. If they're selling only for cash, well, then there shouldn't be any reason for them to have credit terms with you. So that's an ideal situation. So what do? We need to talk to people. We need to talk to people in production. Before we talk to them, we don't just go in and say, guys, we need to be carrying less stock here. We need to sit down and say, and they think, but what, are we being criticized now or what? No. What we need to do is explain everything that I'm explaining to you in this video, so that they feel they're being consulted. They are talking to management. And you find out then, if they ever have any backups of inventory arriving in the production area that they're not using in that same day, because then there's a problem. So the next person we talk to is the people that are in purchasing. Now, are they purchasing too much and stock is building up in the warehouse, stores, and so on? Well, if there is, we need to find out why. Now, businesses sometimes do buy more than they need. This could be for strategic reasons. If their knowledge of business and what's going on in the business world is up to date, they may well hear that one of their large suppliers is experiencing industrial relation problems And they could then have a strike, which means we are not going to get the goods and material that we need to do production. So there's a case where we might well take preemptive steps to ensure that we have the stock by laying a larger amount of stock so that we don't run out of production. We don't stop production because we're affected by that strike. Sometimes we get knowledge that prices from our suppliers are going to be reduced. There's something going on. Now, of course, we need to find out why. Why are prices for a particular product going down? Well, it could be that they're producing something that uses copper or something like that, and copper prices have gone through the floor, and therefore they are still able to make money and charge us less. And we wonder, well, how long is this copper price going to be lower? If we can find out with any certainty, well, this is difficulty, we might well then take advantage of those lower prices to build up stocks of those. And yes, we'll still have holding costs, but they will be lower. And because the purchase price is lower, we should be more profitable as a result. So, there's that. Once we've spoken to all of those people, it may well be a good time to get them together. Because in a larger organization, sometimes those people never talk to each other. And so it might be a good idea to get them in and run them through what I've been discussing with you now, explaining why and what their contribution will give to the company. If people feel that they are able to do something about profitability and not just grind away at their jobs every day, they will feel more valued. And you tell them that they will be making a valuable contribution, and therefore get their cooperation. So that's inventory. It's a very important part of the business to management, inventory management at its various stages. But doing it properly, doing it well, can not only improve our profits, but can also improve our cash flow. Accounts receivable. This is the money that our customers owe us. Very often on company balance sheets, this will be the biggest current asset that they have. You wonder why? Well, maybe to increase their sales, they offer good terms of credit. They offer people more than a month to pay. They offer them 2 months to pay, and so on. Well, it may well increase sales, but remember, and it's going to increase your receivables figure at the same time. But we have to remember that that is costing us money. Our money is not in our bank account, it's in their bank account, and so we have an interest cost. We might have increased sales, and so on the income statement showing sales and the cost of sales, nice gross profit, and so on. But what is it doing on the interest expense side? And of course, by having a larger debtors figure, we've also got to consider the risk factor. At all times, we have to consider that. So, the credit process, the granting of credit goes through various stages and various stages of management, and there are certain things that need to be done on a regular basis and not just left until a crisis occurs and these fuckers aren't paying us. So, first of all, credit references. Now, which of their other suppliers of goods and services do they list? Obviously, the ones that they're paying promptly. And so they get a good credit reference there from them. And those are the types of businesses that they list as references. But what they might not be putting on their list is companies that are very unhappy with them, that they don't pay promptly. So how do we find out about this? Well, if we know our industry, we know what our customers buy apart from what they buy from us. Because we need to know things about our customers. We can only get more sales and get more business if we know our customers. So what we do is we start phoning up these other potential suppliers, and some of them might honestly say, oh, no, we don't supply them anything. We wish we did, but we never get their business. And we might get from some saying, yes. Well, they don't pay us very promptly. We are not happy with them. In fact, we're considering closing their account. Good to know before you open an account with us. Now, these credit references should not be confined to only the company as a whole. It also needs to be extended to where you make inquiries about that company's directors. Now, I mean, if these are blue chip companies with mega million turnovers and profits, well, maybe this is not necessary, but a small to medium-sized company, you get credit references, and this costs you money, credit references on all the directors and maybe even some of the senior managers. Right. Apart from that, you also Google each one of those to see if there's been an article which says not good things about them for some particular reason. And you also talk to your contacts in the industry and ask them, do you know these guys? Are they worth doing business with? Because sometimes, you do sales, but frankly, they weren't profitable sales for a variety of reasons, not getting paid on time, etc. So we do all of that. If the company happens to be listed on the stock exchange, well, then what we do is we can look up information. It's easy to get. We look up information on information about directors' dealings in the company's shares. Now, if company directors are buying the shares in the company, this is good. That means they're hoping the company, or they know the company is going to be doing a lot better because they know a lot of stuff. If company directors are selling the shares of their companies, and this has been happening consistently over a period of time, you should be worried. In fact, so worried that even if you own shares in that company, I would dump them, right, before the share price goes down even more, if it has been going down. So this credit reference thing needs to be widespread, not just on the company and the references that they give you. So then we need signed agreements, and your agreement, you should really get your legal guy to check this out to make sure that the wording is correct, etc., and protects you if the customer misbehaves. And the important thing is to get the credit application and the subsequent credit agreement, if there is one, signed by somebody in authority, not some junior buyer working in the buying department that your sales representative has been to see. Because then they could claim, well, who's this guy that you signed with there? And you need to get somebody who's in authority to sign, preferably a financial director, because they're careful about signing things, and a financial manager, equally, accountants, careful about signing things, but you need that authorization to have the account open. Then the other thing is this: there are a lot of companies that just don't pay automatically. In other words, it's due for payment, payment is made. That's how they operate. There was once a company that I dealt with through the company that worked with me. It was a construction company, and we're often subcontracted to them. And they would phone somebody at our firm and say, "Oi, your check is ready. It was ready yesterday. Why haven't you collected it?" And it was wonderful. And by the way, they are still in business in 2020. There have been a lot of casualties in the construction industry. Some construction companies were extremely difficult to get money out of. So you need to be careful when dealing with the construction industry. That's a warning based on my experience. The next thing to remember is that people oil the wheel that squeals the loudest. Now what this means is that people pay those people that they know are going to be bitching like hell because they haven't been paid. So for peace sake, they just pay them. And I came across a particular business owner where I was doing a small consultation assignment. And he'd asked me to come in because he was experiencing severe cash flow problems. So in cases like that, my first question is, can I see your cash flow forecast? And he said, looking blank, cash flow forecast? I said, yes, the one you do an update every month, maybe every week, to see where you're going and what you need in terms of money coming in and money going out. He said, no, we don't do that. I said, oh. Well, I'm going to have to do one for you, and I'm going to need a whole lot of information from you and various members of your staff so that you have a plan. And the plan, it's a plan in one way, but the cash flow forecast is also something that gives you warning signals. So it's something that just has to be done. So I proceeded to do that. And then I needed certain information. Some of the information I got was they did have a debtor's age analysis. And they also had a creditor's age analysis, which was quite interesting. But yep, they had that. So who owed their money, how long had it been outstanding, placed in months, and suppliers, how much had they bought and how long was really, you could see who was overdue and not, depending on the credit terms agreed to. The one I was more interested in, I was interested in them in both. So in order to do this cash flow forecast, I couldn't suck numbers out of my thumbs. This is not stuff you get in a textbook. I then went to their list of payables, creditors, and I took it to the owner and I said, look, do me a favor. I want you to go through this list. Those that absolutely have to be paid at the end of the month, I want you to put an A. Then I want you to go through those ones that your suppliers, that you could roll for a week. You don't pay them at the end of the month when it's due. You pay them a week later or so. So put a B next to those. And then people that you could keep them waiting for a month. They're not a strategic supplier. If they close your account, stuff it. You get something somewhere else. Now, he did that. I got the list. I looked at it. Wait a minute. One supplier that he'd rated as A, it had to be paid, was supplying him a product that you could buy from 20 different companies. Nobody had a monopoly in that industry. You could buy it anywhere. So why make them an A? Roll them, get a new supplier. And so the woman in the accounts department said, oh no, what happens is the day before the month end, Mrs. X from B company phones him and says, Mr. My driver will be around at 9 o'clock tomorrow morning to collect our check that is due tomorrow. Please see that it's ready. And my spouse said, no, come on. She said, he's actually scared of her. And so that check gets made out and boom, she's paid. That's fine. But what about some of the companies that he could have maybe held up for a few days and things. He was really in tight month-end situations. So to get your money in then, let's go back to the other side. What you need to be there is, like Mrs. X who phoned this chap, you need to be the wheel that squeaks the loudest. Because people oil the wheel that squeaks the loudest. Because it's annoying. But it's your money. Ask for it. And I've noticed, particularly in the small business area, that there are people who are somewhat reluctant to ask their customers for money. I've seen that so often. It's your money. Make sure you've got the terms and all the things we've discussed already, credit agreements and so on, and ask for your money. And if they arrogantly tell you, we're not paying you now, we'll pay you next month or something like that, ask yourself, do I want to deal with people like this? Think of the stress it causes to your health, etc. You don't need that in business. Deal with people who will pay you and do all the necessary investigations about that business before you extend credit. Paying suppliers is an interesting one. It's not something you come across in textbooks, but I came across this company that I worked for at the time. I was a financial manager, and this was in the pre-electronics fund transfer business. You couldn't look at your bank account online or anything like that. You got a bank statement at the end of the month, and when you usually collected it, when deposits were being made, big fat envelope, could be a couple of dozen pages of bank statement, and then a pile of checks like that. Now, in this company, there were 4 signatories that could sign checks. 2 were needed to sign a check, in case some people weren't there. 2 of them weren't there. Well, you had 2 left there to sign checks. And my practice was, the first time I did this, I found something out. When I continued to do this, I would sit with this pile of checks and I'd look. And what I was looking for was who had signed them. If I saw my signature, why was this? Why didn't I sign this check? I looked at the date on the check. I looked at my diary. I was there. Why hadn't I been asked to sign this check? Because I signed most checks. And what the hell was going on here? So I called in the bookkeeping person and I said, why was this payment made on the 15th of the month when it should only have been made at the end of the month in terms of the agreement that we have with them? And she developed this very embarrassed look. I thought, oh dear, I hope you haven't done what I'm thinking you've done. And she said, you see Mr. So-and-so who signed the check? I said, yes. His brother-in-law owns that company that supplies us. So immediately 2 things that I didn't like. 1, paying early to our detriment because now we have to pay more interest if we've got an overdraft. And B, we're buying from your brother-in-law? No. Steps had to be taken. So there's that. These are all simple things. I mean, there's nothing here. I hate jargon, but none of this has been rocket science for you, I'm sure. So, in order to implement this, please get your people together. Tell them what you're trying to achieve. Tell them the areas that affect what you're trying to achieve. Explain to the things that I've explained to you. And then get them to be aware of the contribution that they can make through the actions that they take and monitor. And this will make them feel more needed within the organization today. So many people in the world don't feel needed. Make people feel needed. They feel important. So, good luck with this. And what? No, I don't do that. Sorry, that's my producer here. No, it's like people on Facebook that ask for likes. Businesses on Facebook. Yeah, please like our. What the? No, sorry, I don't do that. If people have found this video informative, then great. They can say they liked it. And if they look forward to the other videos that we'll be producing shortly, well, they may well subscribe. Thank you if they do. But I don't beg for that type of thing. I leave it to people's own judgment. Okay. Well, thank you for watching. Sorry about that interruption. And I hope that you have found this useful. If you have any questions about what I've covered here, please put them in the comment section, and I can deal with them in a special video, or I might just reply to your comment that is at the bottom of this video. You see where they appear there. Thank you for watching, and may the rest of your day, week, and year be a good one.